Have you ever wondered why your hard-earned money seems to magically shrink when you travel abroad? You check the exchange rate, and suddenly, your $100 feels like it got a haircut. Why isn't all money just equal? And why does it feel like exchange rates change faster than your phone's battery percentage? Welcome to the mysterious and often misunderstood world of currency. Today, we'll follow the curious journey of a guy named Alex, who's about to discover just how complex and fascinating global money really is. From Vietnam to Germany, from Zimbabwe to Japan, we're diving into inflation, interest rates, imports and exports, and all the behind-the-scenes action that determines how much your cash is really worth. Stick around, because this is the kind of financial knowledge that makes you smarter every time you spend. Let's meet Alex. So this is Alex. He lives in the United States and, like most Americans, he uses the US dollar almost every day. It's what he uses to buy his morning coffee, pay for his Netflix subscription, and fill up his gas tank. But things get interesting when Alex decides to explore the world. First stop, Germany. Germany uses the euro, and when Alex tries to exchange his dollars, he finds that one US dollar only gets him 90 euro cents. A little disappointing, but manageable. His next stop is Vietnam. Here's the shocker. One US dollar gets him a whopping 25,000 Vietnamese dong. His wallet might look thicker, but the value? That's another story. Confused, Alex starts wondering, why does one US dollar have such different values in different places? Why isn't $1 equal to 1 euro or 1 dong? And what's up with exchange rates that seem to change every time you blink? Let's break it all down. Short history of money. Before we get into what makes currencies rise or fall, let's rewind time a bit. Back in the day, money wasn't just pieces of paper with fancy designs. It was tied to something real: gold. This system was called the gold standard. Every currency had value because it could be exchanged for a specific amount of gold. For example, the US dollar used to represent a certain amount of gold sitting in a vault. This system helped keep things balanced. A country couldn't print more money unless it had more gold to back it up. That meant stable exchange rates and less financial chaos. But as economies grew and global trade exploded, this setup became hard to maintain. Wars, recessions, and massive government spending made it difficult for countries to hoard enough gold to support every printed bill. So, by the 1970s, most countries ditched the gold standard and moved to what we now call fiat money. Fiat money is not backed by gold, silver, or any other physical commodity. It has value because governments say it does, and because people believe in it. Some even call it fake money. But really, it's just a new kind of trust-based system. The catch? If people lose faith in a currency, it can quickly lose value. The price of that trust is controlled by supply and demand. The more people want your money, the more valuable it becomes. And if no one wants it, it drops like a stone. Section 1. Inflation. Now let's talk about a word we all hate: inflation. Inflation is what happens when your money starts buying you less than it used to. Imagine having the same amount of cash but walking out of the store with fewer groceries. That's inflation in action. Inflation occurs when there's too much money floating around compared to the amount of goods and services available. If a country keeps printing money without producing more value, the prices of things go up and the money itself goes down in worth. Take a look at Zimbabwe. In the 1980s, the Zimbabwean dollar was actually stronger than the US dollar. Yep, you heard that right. One Zimbabwean dollar was worth 1.35 US dollars. But things quickly went downhill. The government made several poor economic choices, including failed land reforms, widespread corruption, and reckless printing of money. By the 2000s, the Zimbabwean dollar had become almost worthless. At one point, one US dollar was equal to nearly 600,000 Zimbabwean dollars. The country kept trying to fix the problem by changing currencies, removing zeros, and rebranding their money, but nothing worked. Eventually, they gave up and started using foreign currencies like the US dollar and the South African rand. Even today, they're trying to revive their national currency, but that's a story for another time. Still, you've got to give Zimbabwe credit for persistence. Section 2. Interest rates. Interest rates, those tiny percentages, can have a huge effect on currency value. But what exactly are they? Interest rates are essentially the cost of borrowing money. If you take out a $1,000 loan at a 10% interest rate, you'll need to pay back $100. Central banks, like the U.S. Federal Reserve, control these rates to manage economic growth. Now, here's where it ties into currency. High interest rates attract foreign investors. Why? Because it means better returns. If the U.S. offers 5% interest on its bonds, while another country offers only 1%, investors will flock to the U.S. to get more bang for their buck. And to do that, they need to buy U.S. dollars, driving up demand and strengthening the currency. Let's say you invest in U.S. government bonds. You lend them $1,000, and in return, they promise to pay you $50 every year for the next 10 years. Pretty sweet deal, right? That's the power of interest rates. But there's a catch. A country can't just jack up interest rates endlessly to attract investors. High rates also make it expensive for regular people and businesses to borrow money. That means fewer home purchases, fewer startups, and potentially higher unemployment. That's why central banks must walk a tightrope. Raise rates too much, and you slow the economy. Lower them too much, and your currency could weaken. It's all about balance, and that's why investors hang on every word when central banks make announcements. Section 3. Country situation and foreign investment. Now, let's zoom out and look at the bigger picture. A country's overall situation, its politics, economy, and reputation also plays a major role in how strong its currency is. Let's take China as an example. When China opened up to the world in the late 1970s, foreign companies rushed in to set up shop. But to do business there, they needed the local currency, the yuan. That meant a surge in demand for yuan, which helped strengthen China's currency and economy. Other countries try to do the same. They promote themselves as investor-friendly, hoping to attract foreign money. But not all countries succeed. Investors are cautious. They want to put their money where the rules are clear, taxes are fair, and governments are stable. If a country changes its laws too often, raises taxes unexpectedly, or has frequent protests and strikes, businesses get nervous. They might lose money or face disruptions. That's why political and economic stability is a big deal in the world of currency. And if a country is drowning in debt or constantly battling inflation, investors run the other way. A stable environment attracts investment, which boosts demand for the currency. It's a cycle of confidence and growth. Section 4. Export and import. Let's talk trade. When a country exports products, buyers from other countries usually have to pay using the exporter's currency. So, more exports mean more demand for that currency. Take Japan. When it exports cars to the US, American buyers need to use Japanese yen. This increases the demand for yen, strengthening its value. On the flip side, if Japan imports coal from Australia, they need to buy Australian dollars, which increases demand for the Aussie currency. That's why most countries aim to export more than they import. The more others need your money, the stronger it gets. One of the most powerful examples of this is the US dollar and oil. The US convinced major oil-producing nations like Saudi Arabia to sell oil only in US dollars. Since everyone needs oil, everyone also needs dollars. This turned the US dollar into a global powerhouse, often called the petrodollar. Even small countries are affected. For instance, nations like Tuvalu in the Pacific don't have much to export. Their local currencies aren't in demand, so they often rely on stronger ones like the US or Australian dollar for trade. It's a practical choice to stay connected to the global economy. Section 5. Fixed value. Now here's an interesting shortcut. Some countries decide not to play the exchange rate game at all. Instead, they peg their currency to a stronger one. That means their money always equals a fixed amount of another currency. Brunei, a small oil-rich country in Southeast Asia, pegs its currency to the Singapore dollar. One Brunei dollar is always equal to one Singapore dollar. This makes trade and travel super easy between the two countries. Another example is Belize. Its currency is pegged to the US dollar at a rate of 2.1. So 1 US dollar is always equal to 2 Belize dollars. That makes exchange calculations a breeze. But there's a downside. If the US economy crashes or the dollar loses value, Belize feels the pain too. Pegging a currency makes things stable, but it also ties your fate to someone else's. It's like a financial seesaw. You rise and fall together. Why don't we just use one currency? After all this, you might be wondering, why can't we just have one global currency? Something like a world dollar to end all these headaches? In theory, it sounds amazing. No exchange rates, no conversions, just smooth sailing. The European Union tried something close with the euro. It's super convenient. People can travel across Europe without changing money. But here's the catch. Every country that uses the euro gives up control over its own currency. Decisions about interest rates, inflation control, and monetary policy are made by the European Central Bank. This becomes a problem when individual countries face their own crises. When Greece had a financial meltdown in 2009, the effects rippled across all Eurozone countries. Germany, which was doing fine, suddenly had to help bail them out. That created tension and revealed the risks of a shared currency. Now imagine doing this on a global scale. If one country messes up its economy, the whole world could suffer. So, while a single currency might be convenient, it's not exactly practical or safe. Should every country aim for the strongest currency? That brings us to one final question. Should countries try to make their currency as strong as possible? Not necessarily. A strong currency is great for importing. Countries like Singapore benefit from this because they import a lot of goods. A strong dollar means cheaper products for their citizens. But for exporters like China, a weaker currency is sometimes better. It makes their goods more affordable in other countries, increasing demand. That's why China has often been accused of deliberately keeping its currency low, something called currency devaluation. So, what's the answer? It depends. Each country has different goals and strategies. And there you have it, the wild, fascinating world of currency. From inflation to imports, from interest rates to international trust, the value of money is shaped by countless forces working together. If you enjoyed this video and learned something new, don't forget to hit that like button, subscribe to the channel, and check out our other videos. We've got more content coming that breaks down complex topics in ways that are easy to understand and even fun to watch. Thanks for sticking around. See you in the next one.